How do we measure the financial health of our law firm? Is it just a matter of how much cash we have in our pocket at the end of the day, at the end of the month, at the end of the year? As important as cash is, it doesn't tell us the full story of the financial health of our law firm. Today, we're going to look at the financial statement that you will probably spend the most time with, and how and when you should be looking at it. Welcome to Capital Counsel, a weekly show designed to help law firm owners transform the way they view and manage their firm by teaching them how to develop a CFO mindset. Hi, Brian Weirson here. Today, we're going to be spending some time with the income statement. This is part of a mini-series of videos and podcasts that we're doing to talk about the fundamentals of accounting for your law firm. The last episode, we discussed the real foundation, which is the chart of accounts. This time, we'll talk about the income statement, and in the future, we're going to talk about the balance sheet and about cash flow. When we talk about the income statement, we see this called a few different names. Income statement is often very common, but if you work with a software for small businesses like QuickBooks, you'll see it called a profit and loss. Sometimes you'll see it called a statement of operations. There's a few different names. The key thing to remember is that all of these essentially mean the same thing. What we talk about today, profit and loss, income statement, statement of results, statement of operations, we're talking about a very simple and very important financial statement. Before we get too much into this, I want to remind you that you should go back. If you haven't seen it already, check out the last episode that we did, which was about the accounts in the chart of accounts. Also, go back and listen to or watch the episode that was about who your law firm's chief financial officer is. And quick reminder, because you are the executive that's charged with managing your finances, you are the CFO of your firm. That means while we can outsource tasks, we can never outsource responsibility. So it's up to you to understand the financial side of your firm. So what is the income statement? The income statement is a snapshot of your firm's finances for some period of time. What does the income statement of profit and loss look like? The most basic level, what we're looking at is revenue, the money that we made, minus our business expenses, equals our net profit or our net loss. There's a little more that we can break that down to, but that's the general idea, which is why you can see you're going to spend so much time looking at this financial statement. What did I make? What did I spend? What did I end up with? This is not the same as how much cash you have. That could fluctuate, and we'll talk about that more when we talk about cash flow. But we're talking about in this period of time, did my firm make money or lose money? Very important to look at. Now, let's break things down when it comes to an income statement. First, revenue. That's a simple one. As we talked about in the chart of accounts episode, you can break that down as much as you need to, but ultimately we're looking at what money came in as a result of our services. Next, broken down, there's a section called cost of goods sold. Now, the best way to understand this is to think about it the way that I was taught. When we go through accounting courses, the focus is on doing accounting for a manufacturing firm. And really that's because a manufacturing company does all of the functions that can be accounted for. So it's a good way for you to think about it as well. When you're manufacturing something, you're taking raw material, you're doing something to make it into a finished good, and then you're selling it. Cost of goods sold is all of the direct expenses that you incur in order to make your product. So you're going to buy some raw material, you're going to put some work into it in the form of labor, you are going to apply some kind of overhead of your expenses, and as a result, you're going to end up with your finished good and the cost of your finished good. Then you sell it, right? Well, you are a service business, so am I, which is great because it simplifies things a lot. For us, cost of goods sold, we don't have raw material, but we do have labor cost. So for the most part, really exclusively, the cost of goods sold or the cost of sales or the cost of revenue for our firms is going to be in the form of labor. Now, is it all the labor? Not necessarily. It's all the labor that goes into the actual product that we sell or the service that we provide. So if you think about it between billable and non-billable time, billable time is all cost of goods sold, right? That's the time that you're putting in to provide your service. Non-billable time, administrative time, whatever doesn't get included in that billable time, all of that is an overhead expense that's not cost of goods sold. So we're going to have our revenue, what our service earned us, minus our cost of goods sold, our cost of our labor directly applied to that sale, and the result is our gross profit. That's going to tell us, okay, if we were to work only on that and had no other expenses, what is our actual gross profit? So that's the first section of our income statement. Revenue minus cost of goods sold equals gross profit. Let's come back to cost of goods sold in just a second because that's an important one. But let's finish going through the financial statement. The next section is going to be all of your operating and overhead expenses. Really, this is everything that doesn't fall under the category of cost of goods sold. Think about your rent, your subscriptions to softwares, your telephone expense, your other utilities, office supplies, all these other expenses that really can't be applied directly to the service that you provide. All of those go into those operating expenses. Now, you can split that up 100 different ways, but remember, two big things that we're always going to think about as we build our chart of accounts, as we build our income statement, and as well we review it, is what is the purpose of us doing accounting? Again, this comes back to the last episode about the chart of accounts. We really, as service firms, have two main reasons. Since we're not getting loans, since we're not reporting to investors, we really have accounting for two reasons. One is so that we can report to the IRS for our taxes, and second, it's so that we can make management decisions. So what does that tell us? We want to keep things simple. Let's keep things as simple as we can. Let's accomplish those goals, but let's not overcomplicate things. So we don't want to split up the income statement too much into too many different sections. And I'll talk more about this with the cost of goods sold in a second. But we're looking at the operating expenses section. That area is all of the expenses of your business that are not cost of goods sold. Next, we're going to have a small section that may or may not apply to your firm, which is the other income and expenses. Really, these are the things that are not attached to your operations. For example, if you have a bunch of money sitting in a savings account and it's generating some interest, your interest income is probably going to go into that section. You might have other expenses that are related to non-operating. Now, remember simplicity. Your firm, which I assume is going to be a smaller single owner firm because that's who we're targeting with our information here. If you have a small single owner law firm, you probably should have very little, if anything, in the other income section. All right. In the end, we have our revenue minus our cost of goods sold equals our gross profit. Our gross profit minus our operating expenses plus or minus our other income and expenses equals our net profit or loss. What did we make at the end of the day? What is our bottom line, as we like to say in the accounting area, right? What did we make overall? This is the financial statement. Now, quick discussion about cost of goods sold. It would be the most accurate thing to split out your billable and your non-billable expenses in terms of payroll. Now, in practice, the question that we have to think about is, does that make sense? Remember our two goals, IRS reporting and management decisions. IRS has no interest in cost of goods sold versus regular overhead payroll for your law firm. All they want to see is the total payroll line. So we don't have to worry about it for them. For our management decisions, that's something we need to think about. But remember, we want to keep things simple. In practice, if you have a payroll service, I recommend that, by the way, you should not have to be doing your own payroll compliance. You should have, there's plenty of systems that do it for super cheap. But if you have a payroll service, the automatic mapping of your payroll expense is going to be to one line. That's probably okay. What we don't want to get into is a situation where we're having to do manual splitting and saying, okay, if our paralegal worked 40 hours last week and 34 of those hours were billable and 6 were not, I have to go in and make an adjustment so that I can see. I don't think that that is valuable for your income statement. If you can do it simply, if your payroll processor will set that up on your behalf, maybe you want to do that. But the point here is that there are many ways to decipher and to analyze your billable and non-billable time if you track time, or if you do value billing, which is a great way to do business in my opinion. There are other ways that you can track your efficiency than having to split it up on the income statement. So we're always, when we do accounting, especially since we don't have to report it except for to the IRS, we're always going to do a cost-benefit analysis. Could we split this up and make it more correct, more accurate? Yes. Is it going to help us? Is it worth that effort? Sometimes the answer is no. So the point of the story is it's very possible, and there's really no problem if you have an income statement and a profit and loss that does not include a cost of goods sold section. Now, it's good that you know what it is now, but it's not a requirement for you to do business or for you to do the analysis that we're about to talk about. Next, let's discuss that. What do you do with a profit and loss? Now, here's the way things flow in your accounting system. And once again, I'll recommend this all the time, but you should be using an accounting system. QuickBooks Online, which is the one that I use with most of my clients and for my own firm, not sponsored, by the way, that's just a reality of what I use because most small businesses use it. That has a very specific process where you can link your bank account and your credit card account to the system. You keep only your business expenses in those accounts, and you go through and you assign each expense to an account that you've already set up in your chart of accounts. Our electric bill goes to utilities. Our Office Depot purchase for a box of paper goes to office expenses, and so on. You go through and classify those. Then the system maps out each of those accounts to the right financial statement. So you don't have to say, oh my gosh, I bought a box of paper, I know it's office expenses, and I have to remember that that goes into the operating expenses section. You don't have to do that. That's going to get automatically mapped in the system. So all you have to worry about is classifying it to an account that is set up correctly. It's really not a hard thing to do. You can outsource that work. You got to understand it, but you can do it yourself as well. Now, each month, if we are doing the bookkeeping or if we have somebody doing those classifications on a regular basis, your financial statements will be ready every month. Really, if you take a few minutes or your bookkeeper takes a few minutes every single day or a couple times a week, you can have financial statements that are ready in real time. But to look at the financial statements, to look at the income statement or profit and loss, I recommend that this is something you should do every single month. If you're on top of that accounting, those classifications, within a week of the end of the month, you should be able to see accurate financial statements. So what do you look at? Well, first thing, as you get better at understanding your numbers and understanding your business, you're going to get better at analyzing your income statement. So start to just take a look at it and you'll develop your own habits. But let me suggest some things as you get started. First, you should always look at the month's results as a whole. So from the first to the last day of the month, that's what I'm setting up as my profit and loss or income statement. I'm going to look at that. Then I want to compare that to what happened last month. Why do we compare? Because numbers don't mean anything unless they're compared to something else. So how well did I do? Great. How well did I do compared to last month? And you can start to see things, especially when it comes to expenses. If something jumped up or really went down, you can take a closer look and say, okay, my telephone expense went from $100 last month to $900 this month. What happened? Right? You're going to see, okay, we made some mistake in our accounting, or there's some problem that we have to fix with the amount that we're spending. So that's what you want to look at 1 month to the next. That's the very first thing you should compare. That'll help you see a lot of issues or to make decisions that you need to make. Next, you can take a look at this month versus the same month last year. Now, this is especially important if you have a cyclical business. What do I mean by that? I worked with, and continue to work actually, with an immigration attorney who has a big spike in services right after tax refunds come in. So from about mid-February until mid to late April, there's a huge spike because people or family members of somebody who's going through the immigration process get an inflow of cash in the form of a tax refund, and they want to go through the next process of their immigration. So there's a big spike at that point of the year. At the end of the year, there's very little activity. So if you were to look at June, a typically slow month, and compare it to May, you're not going to get a lot of information. Sales went down, some expenses went down, but you don't get a good picture of what happened. Now, since you're a cyclical business, you want to see how did I do this month compared to this month last year. You'll get a better idea of an apples to apples comparison. That's what we're looking for. How else can you look at your financial statements? You can look at it a trend over time. QuickBooks Online, for example, has a report called the profit and loss by month, and you can just take a glance at it and see what's happening to a particular expense or revenue item over a period of time. Is it going up? Is it going down? Was there a big spike sometime? These are things you can take a look at. Every single month, you should be able to run through this in really just a few minutes. Maybe 30 minutes. At first, it might take 30 minutes to an hour. Eventually, you can probably just do it in a few minutes because you'll be so familiar and so on top of what's going on. Every single month, you're going to take a look at that. Then, you might consider on a quarterly basis and on an annual basis doing an additional review that looks at different time periods instead of looking at 1 month to look at several months or a year at a time, and do that same kind of comparison. What happened? How are we trending? How does it compare? One day, and we'll talk about this in the future, you will set up a budget for your firm where you will have expected revenues and expected expenses for each period of time. At that point, you would do an analysis that would compare your budget to your actual. So these are all things, there's really no limit, and I can tell you that because this is my job, and I've always found new things and new ways to analyze numbers. So there's no end to this. As much as you want to get into it, you can. But remember, simplicity is the name of the game. You do not want a complicated income statement, profit and loss. You don't want a complicated process. This should be a quick review that you're able to do to make sure that you're making money. Remember, these are your financials and this is your analysis. You are going to develop your own system, and the people, the professionals that you work with should be changing how they do things to match your style. That doesn't mean that an accountant is going to record things differently because of how you want it recorded. But if there is some part of your business that you're interested in tracking, then a good professional, a good accountant, or a good bookkeeper will pay special attention to that to help you analyze that area of your business. These are your books, and this is your business. I invite you to come back for the next couple of episodes, podcasts. We're going to talk about the balance sheet and cash flow. Stick around and let's go through the basics of the accounting and the analysis for your law firm.
Thank you for joining me on Capital Counsel. If you have questions, concerns, suggestions, drop them in the comment section. For free resources like my cash flow projection for law firms mini course, and for more info on designing your ideal law firm, check out Consilium-CFO.com.